Welcome back in YouTube. In this video, we're going to talk about a few stocks that, well, they're definitely getting beat up here. The charts are ugly and they're extremely cheap from a relative perspective. Now, are these companies going to be buys? Well, we're going to talk about that in this video. Both these companies trade for under $8 a share. And I tend to think that both have some serious upside. Yes, there is risk with them, but let's get into it. Now, when this company IPO'd a while back, it was trading for over $40 a share. Fast forward to today, it's trading at $6.56 a share. Now, here's the interesting thing. The company is actually growing revenue, and margins have been a problem with this company. Inventory levels have been a problem with this company. But after looking into their quarterly report, I do think that there is some opportunity here. Now, Under Armour has a new CEO in Stephanie Linnartz. And what I like about this is she was the Global Chief Commercial Officer at Marriott, which we know as an upscale hotel chain. And it's time to make Under Armour an upscale brand as well. And I also think it's time to have a little bit of a women's touch on the brand. Women tend to spend a lot more, as we can look for a company like Lululemon, on apparel than men do. Men are bargain shoppers, more functional. Women are all about quality and design and willing to pay that premium. We could look at brands like Louis Vuitton, and as I stated before, Lululemon. So the question is, can Under Armour now demand a little bit more out of their brand with this new addition? Now, this thought process is absolute speculation. But what I want to do is I want to dive into their quarterly reports and see if there's any opportunity within the brand and take the emotion out of it. So let's get into it. So first thing I want to point out is in 2015, the company was doing $4 billion in revenue and is now pushing $6 billion in revenue. So are they getting top line revenue growth? And the answer is obviously yes. Is it happening as fast as we all would like? No. But remember, the market cap on this company is literally sitting at $3 billion, which is extremely low and depressed when we factor in that this company is doing nearly $6 billion in revenue and is still growing. Wells Fargo did downgrade the company recently, actually giving it some upside here as it's trading for $6.50 roughly, and it has an $8 price target.
All right, Under Armour shares dipping on a downgrade from Wells Fargo. The analyst lowering the athletic company's rating to equal weight and slashing its price target to $8 a share from $12 a share. Now, the team at Wells Fargo citing three main issues for Under Armour: outsized wholesale exposure, elevated inventory, and C-suite shuffling. Elevated inventory, that's something we've been talking about a lot when it comes to these retailers. Under Armour's elevated inventory was up 44% the last quarter. So they need to do even more here, really a lot, to clear some of that excess inventory that they've been struggling with. And that C-suite reshuffling, their new CEO, Stephanie Linnartz, she's only been in the job for less than 6 months.
It's actually projected to do right around 4 to 5% revenue growth going all the way into 2027. And we can see earnings should follow this as well. The other thing I want to point out here is they are buying back some shares, and I think it's because they understand that the company is completely undervalued here and that there's a tremendous amount of upside with fairly low risk at these levels. The other thing is they went from $2 billion in debt to roughly $1.5 billion in debt, so they're paying down their debt, they're buying back stock, but yet the stock price is actually heading down while top line revenue is growing. Now, with a lot of retailers, I want you guys to pay attention to the amount of debt these retailers are taking on, as the story with Under Armour is they're actually holding their debt levels at a comfortable level. Yes, it's a little elevated, but comfortable overall. I think they can handle this. When I start looking at some of the other retailers, they are actually loading up on debt, and this is going to ruin their future growth, especially in a higher interest rate environment. So when we look at income from operations, we can see here that it is down year over year, but when we compare the quarter of 2023 to the quarter of 2022, we can see that there is some more efficiencies here. And net income is coming in a little bit stronger. Once again, share count is actually heading down. We like to see that. We can break it down from accessories to apparel to footwear. And as we can see, footwear is actually skyrocketing, going up 16.3%. Yes, we had a small dip in apparel, but like I said, maybe there's an opportunity for a women's touch here and to get some more premium on this. This is going to be an interesting one to watch as it is up in the 3 months compared to 2022. And take a look at where footwear is in the 3 months compared to 2022. So we're actually seeing that the quarter was pretty strong here, with a big boost in footwear and a little boost in apparel. Now, inventory levels are fairly high with the company, so we're going to see the wholesale go up, but the area where we want to see growth is going to be direct to consumer. This is going to be the highest margins for the company and impact top line and bottom line most drastically. And as we can see year over year, not that strong, but once again, it looks like the quarter was more efficient. When we're looking at the quarter here, I'm seeing a lot of positive things, and the stock is not being rewarded for this, which is telling me that either the market's pricing in something bad for the company, or this is just an opportunity here. When we look at regional sales for the company, we can see that obviously year over year, North America was down, but take a look at what happened for the quarter. Once again, a nice pop for the quarter. When we look at Europe, Middle East, and Africa, we can see, look at the big spike in sales. 13.8% in the quarter, 13.2% year over year. Asia Pacific, 2.7% for the year, but take a look at the quarter once again. Guys, this is a pretty good quarter for Under Armour, and it is definitely not getting rewarded here. Now, granted, a big downfall in Latin America, but when we look over year, it's actually up 10%. So luckily, luckily the year saved them, but we can see here an inefficiency on the quarter. But when we look at the segment, it is the smallest. So any move in either direction is going to be a high percentage because of that. So we have to kind of take that with a grain of salt. Now, this is a company that has over $700 million on the balance sheet, and total liabilities is $2.8 billion. Factor out the cash, you're looking at right around $2.1 billion of total liabilities, and they have a credit line of over $1 billion. So I would say that this company financially can handle a pretty significant downturn. So as we saw from stock analysis, they're projecting between 5 to 6% revenue growth, and then we got the next 5 years from Yahoo is projecting 21.8% revenue growth. Yeah, guys, I am not going to get behind that, and the good thing is I don't have to get behind that because I think the stock is going to be fairly priced between 5 and 6%, but let's plug in the numbers and see what we come up with. So I do think we're going into a tough time, and yes, the quarter over quarter was strong, but I'm going to build some protection here and say years 1 through 3, they're going to do about 4%. Years 3 through 6, they're going to do about 6%. And then I'm going to bring it down to roughly 3% from years 6 through 10. When we take a look at EBITDA margins, we can see here that they are kind of all over the place. And you're going to see this with retail. Sometimes they miss, sometimes they hit. Because this is a margin story, the free cash flow story is going to be similar, where it's just all over the place depending on how strong the year was. Now, we've seen them handle their debt, so we're going to say that they're going to still keep handling their debt. And even though they're buying back stock, I'm actually going to say that they're not going to buy back stock, because if you look through their history, they've actually put some shares on the market. So I'm going to just be in the middle here and say historically, they're not going to buy or add shares. It's going to be a net zero. From a free cash flow standpoint, guys, we could be paying up to $7.50 for the stock. From an EV to EBITDA, we can see here it trades for a 9, while industry standard is roughly 10, so it's definitely trading for a discount. Nike trades for roughly a 24 multiple of EV to EBITDA. So we get $4.64 from an EV to EBITDA, and we get $7.65 from a free cash flow standpoint. Now, before you guys freak out and say, well, that only averages out to about $6.15. I want you guys to take a look at what enterprise value to EBITDA was in the past when they had stronger growth rates and better margins. They demanded a higher multiple. And so now I'm going to actually bump it up to 12 because I do think that the multiple is extremely depressed here. And I think that when we look at a trailing PE at 8 and a forward PE at 12, there's definitely some opportunity here for the stock to have multiple expansion. And so I'm going to use 12, and we get a $5.62 stock, giving us an average price of $6.64, which to me means if this gets any lower, the more compelling of a buy this is becoming for me personally. I'm using extremely low margins and extremely low growth rates, and I'm still getting basically a buy at these levels. So I want you guys to keep that in mind because I tend to think that this company has a lot more upside than people are thinking. They have upside for margin expansion. They can go back to double-digit margins. They have upside for growth. And with fresh new management in there could be some things that are not being seen. So let's talk about another stock here that I'm just going to touch on really quick. As we all know, the housing market's getting crazy, and I tend to think that this one is also getting pretty interesting. So the stock I'm talking about is going to be Newell Brands. And what I want people to pay attention to on the chart is that this is obviously a cyclical business here with the massive ups and downs. It really comes down to the consumer. And me personally, I think it really comes down to a strong housing market. Now, what I want people to consider is through the pandemic, we had an explosion in the housing market, and we saw Newell Brands hit as high as nearly $30 a share. Now, what has happened over the last 2 years with rates on the rise and people not wanting to leave their homes with that 3% interest rate is now leaving the housing market in kind of a dead zone here where it's all about new builds. New builds are going to be the next thing. And if there's that much demand for new builds, I tend to think there's going to be that much demand for Newell products. Now, before we get into what Newell does, I do want to point out that this to me is not as safe as of a stock as something like Under Armour. This company does do pretty strong top line revenue of over $9 billion in revenue. And as we can see here, got up to $10.5 billion in 2021. This is also a company that actually has usually pretty decent cash flow with high inventory levels and not selling as much product. They're obviously dealing with some inventory issues and a slowing consumer as well. So yes, this could be the opportunity to buy in the cyclical aspect of their business. Is the debt load is starting to get to a little heightened levels here when we factor in that their cash flow is negative and this is a turnaround story. Taking on $5 billion worth of debt, to me, is definitely a red flag here. So these are some of Newell's brands, and when we think about back to school, we can see that there would be a pretty good influx of these types of products being bought. But the one thing is we are definitely going more digital. And so are some of these things going to be outdated, or maybe are they going to not be as needed? And I think the answer is yes. But where this brand gets a little bit more interesting is the fact that home fragrance, home appliances, and commercial. Rubbermaid, we all know Rubbermaid. Home fragrances, we all know Yankee Candle and Woodwick. Crock-Pot, I think most people have a Crock-Pot. Most people are familiar with Oyster as well and Mr. Coffee. And then, of course, the outdoor brands of Coleman Grills. And so when we look at Newell Brands and we think that there's going to be a housing boom and a housing shortage, then I tend to think that a lot of homes are going to be needing these types of brands in the very near future. I'm not talking about, next 6 months to a year, but I'm talking about the next 3 to 5 years. And so the one thing you want to monitor with this company is going to be the balance sheet, in my personal opinion, making sure they're not taking on too much debt and making sure they're not diluting too much as well. Hopefully everybody enjoyed that. Wanted to go over some stocks that I think are, decent deals at these levels, starting to get pretty interesting. And I think that have a little bit more upside than the market is pricing in. So as always, guys, let me know what you think about those two stocks, and we will see you in the next one. Peace.